Time now for Smart Charts with Abigail Doolittle, where we look at timely topics through the charts with the street's top technicians. And Abigail, you're taking a look with your guest with some commentary on the Fed 2 weeks ahead, of course, of that highly anticipated July meeting. What did the charts say?
Well, you're right about that, Taylor. And to break down the charts around the Fed and the possibility or the likelihood even of a rate cut, Ari Wald of Oppenheimer. Great to have you here as always. And you've really outdone yourself. Let's take a look at your chart here, which talks about a 25 bip cut versus a 50.
Sure. With the upcoming Fed meeting, clients want to know are the implications for the equity market? Is it going to be like 1995 and 1998 when you had a Fed cut that was followed by continued gains in the market? Or is it going to be like 2001 and 2007 when you had a Fed cut that was followed by a significant drawdown in the market? Now, we did some work on this. We looked at the 9 Fed cutting cycles going back the last 50 years. So still a pretty small sample size. But what we found is that when the Fed cuts by 25 points or less, you tend to see higher forward returns. That tends to signal it's more of an insurance cut the Fed's getting in front of the issue. Conversely, if it's a 50-point cut or greater, you tend to see negative returns, poorer and more of a risk of an economic recession. Tends to suggest the Fed, that aggressive move by the Fed, they're a little bit too late to it.
Yeah, it sounds pretty defensive there, but not defensive. If we take a look at your next chart, we certainly have big growth outperforming small value.
Yeah, so let's tell the market story here. And when we think of big versus small, growth versus value, to us, the key leader has been big cap growth. That's the Russell 1000 in the top. The key laggard's been small cap value. So how we think of it, you want to root for the weak and invest in the strong. Now, our view is that this is the dominant chart in the top panel, that we're still in a bull market that's going to be led higher by large cap growth. But here's the risk to our view, is if this small cap value starts to head north and really starts to nosedive. I don't think that's the case yet, but that's the risk.
And very quickly, momentum, love this chart too.
Let's rotation idea right in the middle. Small cap momentum, less extended than big caps, not at a new high yet, but more strength than just the Russell 2000 alone. Here's the small cap momentum ETF, DWAS. It's cleared 9-month resistance and also turning higher versus a very strong S&P 500 benchmark. Very tough to find a small cap ETF that's showing that much of a turn on a relative basis.